Have you ever wondered if a dividend cut could actually set up a company for future success? Today, I'm going to break down Bell Canada's recent dividend cut, explain why it's more than just a short term setback, and explore alternatives along the way. We're going to uncover some tactical ETF options that let you avoid the headache of those dividend cuts. Bell, let's talk. They recently announced in their quarterly earnings that they're cutting their annual dividend from $3.99 to $1.75 per share. That's a major cut of more than 50%. And this dividend cut isn't just simply a knee jerk reaction to market pressure, it's a strategic move in order for them to secure their long term financial future. So what does that mean? Well, Bell has been investing heavily in modernizing its network and digital infrastructure. And this means that significant capital, approximately $2 billion, gets to be redirected from maintaining their high payout ratio to investing in new technologies. Well, why now? Why did they decide to cut their dividend? Well, it's all about timing. Rising debt levels from past acquisitions and increased interest rate pressures, it just became unsustainable to maintain that high payout ratio. It's just math. If you're paying more to your shareholders than you're actually bringing in, you have no choice but to cut your dividend. To adapt, Bell Canada has actually changed how their dividend policy works. The new policy is now that they're targeting for the payout ratio to be between 40 to 55% of free cash flow. And that's important because what this allows them to do is tie dividends directly to companies' actual cash generation. If they're not making as much free cash flow, they're not going to pay as much. So it allows a little bit more flexibility for their long-term financial operations. In short, Bell is not going to prioritize its long-term financial future, but if you don't want to go for the ride, let's explore two major alternatives to Bell. And these are direct competitors to Bell, and two names stand out: Rogers and Telus. Starting with Telus, this is no longer just a pure play telecom company. They have expanded their reach, especially when it comes to health. Since 2020, their digital health division has grown approximately 4x since 2020. That's amazing. You can see this has become a foundational business platform for them, not just telecom, but health. And if you know from macroeconomics, health is a huge area for growth. And this strategic expansion into digital health is going to help them diversify their revenue stream. As I've always said on this channel, it's always better to have multiple income streams, and Telus is no different. Turning to Rogers, they're taking a different approach than Telus, but along the same line of thinking, they are expanding into the sports broadcasting category. Recent data shows a 12 to 15% surge in sports content viewership just over the last quarter. And with Rogers, by ramping up their investments in this area in sports broadcasting and sports content viewership, they also get to diversify their revenue away from just telecom. By investing in this area, it allows them to capture additional advertising revenue, additional subscription revenue from an industry where engagement is at an all-time high. So which approach do you find more compelling? Prefer the Telus play into digital health, or are you more interested in Rogers and going in that sports broadcasting area? What do you prefer? Let me know your thoughts in the comments down below. These options that you can see are two distinct from one another. One is health, one is sports. But if you are still concerned about the amount of work that you have to put into in maintaining a portfolio of dividend stocks or just stocks in general, the research, reading financial statements, is there going to be a dividend cut? Is the company growing? Is it shrinking? If all that sounds like way too much work, then ETFs might be the way to go. By investing in ETFs, you're going to gain broad exposure to different markets, or you can even focus a specific sector to focus on, but you will get to still diversify away from single stocks. As you can see, I've put together an ETF list for you that allows you to still invest in the telecom sector, but you get to diversify away from single stocks. So the first one I have is VCN, which is the broadest of the broadest that you can get in Canada, over 150 to be exact, 159 stocks with just one ETF and an ultra low MER of 0.05. Now you only get 2% exposure to telecom, and that's because majority of Canada's big industry is financial services, energy, minerals. So telecom only makes up 2% of Canada's overall market. And that's the beauty about investing in a broad market ETF, that your exposure is going to be right along the lines of the overall market. So if Telecom made a larger exposure to Canada's overall market, then this will be higher. You don't have to worry about how much exposure you're getting to Telecom because this will go up and down to reflect market reality. So in this case, it's 2% today. And if you look at this overall 9% return, this shows that you're going to capture solid growth across the board and you're going to get a decent 3% yield along the way. To me, this ETF is perfect if you want to build a diverse strategic foundation of pure Canadian equities. Next up, we have UMAX, which is going to focus on the utilities and infrastructure sector. And this is a lot more concentrated than VCN, where you only have 13 stocks in this one ETF and a fairly heavy exposure to the telecom space at just under 22%. It's designed for defensive investors, and that is evident by that 15% yield. Also, the MER is over 1%. Honestly, when it comes to ETFs, when I'm looking at them personally, anything above 1% makes me a little iffy. But again, I want to highlight options for you in case it makes sense for your portfolio. So you'll notice something that even though the dividend yield is about 15%, the average annualized return is 5%. What you're trading off is overall total return for a higher dividend yield. And that's what I meant. It's for defensive investors who are okay trading off total return for a dividend yield. HUTS is very similar to UMAX. It will also get you roughly a 21.5 exposure to telecom space, 12 stock in this one ETF, and you still get a dividend yield of over 7%, which is fairly good. Now, the problem with this ETF, and this is where I struggle with this, is that it has an average annualized return of actually minus 1%. So this data is, yes, you're right. You're not seeing an error. You're actually losing money with this ETF. Not to mention, it has an extremely high MER of over 2.2%. So it's critical that if you're interested in this ETF, you understand that you might be getting a great dividend yield of 7%, but overall you're losing money and you don't want to lose money in the stock market. So this ETF, again, I'm going to put this as an option, but I would generally stay away from ETF. The first red flag is that it has a minus return, so no good there. It has an extremely high MER of 2.2%, so again, another red flag. Generally speaking, stay away from HUTS. The other ETF I want to show you is RING, and this is a fairly recent entry into the world of ETFs, having launched in around November of 2024. And the interesting thing about this ETF is that it actually only has 3 stocks in its portfolio, and it's essentially equally weighted among the telecom companies. So you get a third exposure to Bell, another third exposure to Telus, another third exposure to Rogers. On the bright side, it has a fairly low MER, and I would expect to see a very low MER. It only has 3 stocks. The reason you would want to invest in this ETF is that if you can't decide if you want Telus, Rogers, or Bell, and you want an easy way to invest in those 3 companies, sure, go ahead, look at Ring. But I'll be honest with you, 3 stocks. You're better off just holding those 3 stocks in your portfolio. Maybe you have your own equal split. I wouldn't really go for RING, but again, it's an option to show you that ETFs like this do exist, where you see only 3 stocks in an ETF, or you can actually see ETFs of very high MER, a very high dividend yield, but you're losing money along the way. The last one I want to show you is ZLB, which is the low volatility Canadian equity ETF. And what I like about this ETF is that it focuses on Canadian equities like VCN, but it focuses on the ones that have typically lower volatility. As you can see, this only has 52 stocks, which is much less than VCN at 159, but still offers a very good yield at 2.2%. You can see these ETFs offer a different way to capture market returns. Some will focus on a broad market, some will focus on a very narrow, just one subsector of the market, and that is telecom, ring, 3 stocks. But what you'll notice is that only 3 of the stocks I've talked about. And what you'll notice about this listing is, and that's why I have these graphs out here, is that VCN, it's actually grown 102% since inception. ZLB has grown almost 200% since inception. All the other 3, UMAX, HUTS, RING, they have all lost between 7 to 15% since inception. And what I want to highlight here is that that's the risk when you just chase dividend yield. If you're not doing your analysis, if you are just going by Reddit or a friend that told you about, hey, invest in this ETF, it's got a 15% yield, you have to look a little bit deeper, and that you'll see that, yeah, it has a 15% yield. That's because you're losing money along the way. Your capital appreciation is not there. You're actually seeing capital depreciation, meaning if you invested in this ETF at 1440, well, now it might be worth 1350. Yes, you got some dividends along the way, but you're trading away capital for a dividend income stream. And worst is this one, HUTS, extremely high MER. Dividend yield, sure, you can get a 7% dividend yield, but you're actually losing money along the way. And that's very important to understand. Don't just look at yield in isolation. Take a look at the MER. Take a look at total return, because what's the point of collecting dividends if you're actually losing money altogether? So that's why if you really want exposure to the telecom sector, sure, you can go after these three ETFs, but if you really want to focus on telecom, go for a broad market index ETF like VCN or something similar where it has still a broad market focus, but focusing on something like low volatility in ZLB. So to wrap up today's discussion, yes, Bell cut its dividend payout, but really had no choice because it became unsustainable. And they're going to take those savings and reinvest into their own network, reinvest into digital infrastructure, or just try and pay down debt. And you have two great alternatives if you still want to focus on single stocks. And those are direct competitors of Bell. You have Telus, who's going to focus on this booming space of digital health. Then you have Rogers focusing on another area of growth, and that is sports viewership. So they're betting on getting more revenue through that long-term subscription of people who are interested in watching sports. Each offers a unique path to sort of diversify out of this telecom landscape and go after other areas of growth. And if you're not interested in investing in single stocks because you don't want to be bothered with the extra work that's involved in reading financial statements, keeping up with the latest news, also it's just a headache in picking stocks. So that's why you can look at options like ETFs. With a single ETF, you're going to get a basket of, and for example, VCN, of over 150 stocks. And that market is always going to be aligned to reality. So if one sector is a small exposure to Canada, that's what it'll reflect. You still get a dividend yield along the way, as you saw with both ZLB and VCN, between 2 to 3%. And even for me personally, I prefer to invest in ETFs. And that's why on this channel, you've probably seen me talk so much about ETFs in different videos. It just avoids the hassle and the work that goes behind picking individual stocks. Now, before you go, I really do want to hear from you in the comment section down below. What strategy are you going after? Have you thought about dropping your individual stocks because of Bell's announcement, where you see that the cut of dividends is real? Are you now moving more towards ETFs? Or are you somewhere in the middle where you prefer to have some stocks, but balance that out with ETFs, more of a hybrid strategy? I want to hear from you. Drop a note down below. Has your investing strategy changed? If you found this video helpful, hit that like button, hit that subscribe button, because it lets me know you want to see more content like this, and that's the content I want to focus on. That's it for now. I'll talk to you in the next one.